For decades, the 4% rule was the golden standard in retirement planning. A simple formula: withdraw 4% of your portfolio each year, and your money should last 30 years. But here's the problem: we don't live in the same financial world anymore. Low interest rates, volatile markets, inflation, rising healthcare costs, they've changed the game. So today, in 2025, many financial experts are asking, is the 4% rule dead? And if so, what should replace it? Let's break down what the 4% rule was, why it may no longer work, and what smarter, safer alternatives exist for modern American retirees. 1. The origin of the 4% rule. The rule came from a 1994 study by financial planner William Bengen, who tested different retirement withdrawal strategies using historical market data. He found that withdrawing 4% of your portfolio in year 1, then adjusting for inflation each year after, gave you a 95% chance your money would last 30 years. It became the retirement gold standard. But it was built in an era when interest rates were higher, inflation was lower, healthcare costs were predictable, lifespans were shorter. In 2025, all of that has changed. 2. The big problem in 2025: sequence of returns risk. The biggest threat to the 4% rule isn't just inflation, it's when bad market years happen. Let's say you retire in a market downturn, like 2024-2025. If your portfolio drops 20% in year 1 and you withdraw 4% anyway, you're locking in massive losses. This is called sequence of returns risk. It's not about average returns, it's about timing. The 4% rule doesn't protect you from that. 3. Longevity, a blessing and a challenge. Back in the 90s, most people planned for 20 years in retirement. Today, a 65-year-old couple has a 50% chance one spouse lives past 90. Some will live into their late 90s or even past 100. If you follow the 4% rule for 30 years, but live 40, you might run out of money in the final decade of life, the years you may need it most. 4. Inflation changes everything. The last few years have shown us what inflation can do. Healthcare inflation alone outpaces general inflation by 2 to 3s. In 2026, even basic expenses, groceries, gas, housing, remain elevated. A 3 to 4% inflation rate over 25 years cuts your buying power in half. The 4% rule assumes inflation is predictable. It's not. 5. Low bond yields and market volatility. The 4% rule was built on assumptions of 60% stocks, 40% bonds. Bonds earning 5 to 7%. Steady, moderate growth. Today's reality: bonds are earning closer to 2 to 3%. Stock markets are volatile and unpredictable. The traditional 60-40 portfolio may no longer offer enough safety or growth. The result? 4% might be too aggressive. 6. Real-life story: Mark and Diane. Mark and Diane retired in 2021 with $1.2 million. They followed the 4% rule and withdrew $48,000 per year. Then came a 20% market drop in 2022, higher living expenses due to inflation, unexpected medical bills. By 2025, their portfolio is down to $830,000, even after a small market recovery. Now they're wondering if their money will last 20 more years. The 4% rule gave them confidence, but not protection. 7. So, is the 4% rule dead? Not entirely. But it's no longer a one-size-fits-all solution. Think of it like this: for some people, 4% is too much. For others, especially with guaranteed income, it may still work. But the key is flexibility. You need a dynamic retirement strategy, not a static formula from 30 years ago. 8. Smarter alternatives in 2025. Here's what many financial advisors now recommend. The 3% rule: more conservative, allows for longer retirements, safer if retiring into uncertain markets. Guardrails strategy, created by financial planner Jonathan Guyton. This method adjusts withdrawals based on portfolio performance. If markets do well, withdraw more. If markets drop, reduce withdrawals temporarily. It preserves capital while giving you flexibility. Bucket strategy. Divide savings into 3 buckets: short-term, 1 to 3 years; cash or CDs, medium-term, 3 to 10 years; bonds, conservative investments, long-term, 10+ years; stocks, growth funds. This strategy shields short-term needs from market crashes. Partial annuities for guaranteed income: use part of your portfolio to buy a fixed annuity or deferred income annuity. It guarantees income no matter what the market does. 9. Build flexibility into your plan. The key lesson in 2025 is adaptability. Life will change, so should your retirement strategy. Tips: review your withdrawal rate annually, revisit your budget every 6 to 12 months, stay diversified, be mentally and emotionally ready to spend less during bad market years. 10. The rule is not the plan. The 4% rule was never meant to be a law. It was a helpful starting point, not a finish line. In 2025, retirement isn't about a single rule. It's about understanding the risks, planning for a longer life, staying flexible in a changing world, having multiple income streams and a backup plan. So don't cling to a number from 1994. Instead, build a retirement plan that's rooted in reality, backed by data, and strong enough to bend without breaking. Because the real rule of retirement: there are no rules, only what works best for you.